Hey everyone, welcome back to Corporate Decoder, the place where we untangle the truth behind corporate filings. And let me tell you, Redwood Trust has some interesting things cooking in their latest report, especially around how they're raising money. This report is all about the company updating how it plans to sell more of its stock, and we're going to break down what that means for you and the company's future. Before we dive in, if you like getting these clear, no-nonsense explanations of complex financial documents, make sure you hit that subscribe button. And hey, we've got a fantastic community over on our Discord server, linked in the description below, where we chat about these filings and more. Come join us. Alright, let's get right into it. We're looking at a current report filed by Redwood Trust, Incorporated. The earliest event reported here is the 7th of November 2025. Now, this isn't your typical quarterly or annual report full of detailed financial statements, but it is crucial because it tells us about some important behind the scenes actions the company is taking, particularly how it plans to get more funding. The main event here is a filing related to a prospectus supplement. Think of a prospectus like a detailed brochure for investors, and a supplement is an update to that brochure. Redwood Trust has been working on ways to raise capital, which is basically money, and this filing is an update to their plans for doing just that. They've been quite busy. Back in March 2025, they filed a new registration statement, which is a big document that tells the government all about the securities, like stocks and bonds, that a company plans to offer. This new filing in March replaced an older one. Now in November, they're adding to that by filing a prospectus supplement. This prospectus supplement is specifically about their at-the-market equity offering. What does that mean in simple terms? It means they have the ability to sell their common stock, which is the regular stock that most people think of, directly to the market whenever they see fit, up to a certain amount. In this case, they are planning to raise up to a massive $175 million through this program. Imagine a store that can decide to sell more of its products whenever customers are buying, but with stocks instead of goods. That is a bit like what an at-the-market offering allows. And as is standard practice for such filings, they're providing legal opinions. This ensures everything being offered is on the solid legal ground. It's like getting a lawyer to give a stamp of approval saying all the paperwork is in order. Now, to actually sell these shares, you need a sales team, right? That brings us to the next part of the report, an amended distribution agreement. Redwood Trust has updated its agreement with several financial institutions acting as sales agents. Think of these agents as the brokers who will be executing the sales of the company's stock on the market. This amendment, dated the 7th of November 2025, is essentially updating the existing deal to include the sale of common stock under the new registration statement and the prospectus supplement we just talked about. The core terms of the deal, like how much they can sell in total, seem to remain the same. But this formalizes the process for this new phase of selling stock. So what is the story here? Redwood Trust is actively managing its capital structure. They've set up a way to offer and sell a significant amount of their common stock directly into the market. This at-the-market program, bolstered by this updated distribution agreement and the prospectus supplement, suggests they have plans that require substantial funding. Or they simply want the flexibility to raise funds quickly if opportunities arise or if market conditions are favorable. The list of agents involved is pretty much a who is who of major financial players: BT, Citizens, JMP Securities, Goldman Sachs, JP Morgan, and Wells Fargo. This indicates the significant underwriting capacity and market reach that Redwood Trust is leveraging for this offering. Having these big names involved is usually a positive sign, suggesting confidence from these institutions in the company's ability to execute such an offering. While this report doesn't give us fresh financial numbers from an income statement or balance sheet, this event has implications. For shareholders, it means potential dilution when a company sells more shares. The ownership percentage of existing shareholders can decrease. However, it also means the company has a war chest to potentially fund growth, acquisitions, or to manage its debt. It's a balancing act. Looking at the securities listed in the filing, we see common stock, series of preferred stock, and various senior notes. This diverse capital structure shows Redwood Trust uses a mix of debt and equity to finance its operations and growth. The fact that they are actively planning to sell more common stock through an at-the-market program, while also having senior notes outstanding, indicates a strategic approach to managing their financial obligations and opportunities. The decision to file this prospectus supplement and amend the distribution agreement signals proactive financial management. It suggests Redwood Trust is anticipating certain needs or opportunities that require readily accessible capital. It's not necessarily a sign of distress, but rather a strategic move to maintain financial flexibility in a dynamic market. Now, what is my take on this? Redwood Trust is clearly focused on maintaining access to capital, which is a smart move for any company, especially in the real estate investment trust sector where capital flows are crucial. The @ market program is a flexible tool, allowing them to raise funds as needed without the immediate commitment or market disruption of a large one-off stock offering. The involvement of top-tier financial institutions is a vote of confidence and provides them with the sales infrastructure they need. However, the key risk for current shareholders, as I mentioned, is dilution. If the company issues a lot of new shares over time, the earnings per share could go down, impacting the stock price. The company needs to ensure that the capital raised is strategically deployed to generate returns that more than offset this dilution. The real test will be how effectively Redwood Trust uses this newly accessible capital to drive growth and profitability. Are they investing in new properties, expanding their lending activities, or something else that will create long-term value? That's the story we want to see unfold from these filings. So, that is our quick decode of this Redwood Trust filing. It is all about positioning for future capital needs. What are your thoughts on companies using at-the-market offerings? Do you see it as a sign of strength or potential dilution for investors? Let me know your opinions in the comments below. If you found this breakdown helpful, please give this video a thumbs up and be sure to subscribe for more regular dives into the world of corporate finance. Also, don't forget to join our Discord community through the link in the description where we keep the conversation going. Thanks for watching, and I'll see you in the next one.